There was a man in the early 1700s who figured out something dangerously simple. If you can convince people that paper is wealth, you can create wealth out of thin air. His name was John Law. He persuaded France to let him run their national bank, promised prosperity backed by land in Louisiana, and within 2 years, the entire country believed they were getting rich. People sold property, jewelry, businesses, anything they could to buy shares in what was essentially swampland wrapped in a great story. The price kept rising, and because the price kept rising, people assumed it was safe. Until it wasn't. When confidence cracked, the whole structure collapsed. Fortunes vanished, the economy froze, and the people who trusted the system the most were the ones left holding worthless paper. Now here's the uncomfortable part. The same pattern is happening again, not with powdered wigs, not with paper money, with your index fund. Here's what makes the John Law story important. It wasn't unique, it's a pattern. First, a small group of assets gets labeled as can't lose. They're innovative, dominant, essential. Then capital floods in, prices rise. Rising prices become proof of quality. More money pours in. Valuations detach from reality, but nobody cares because everyone's getting richer on paper. Then something shifts. It doesn't have to be dramatic. A recession, tighter credit, slower growth, and suddenly the same assets that felt bulletproof have the furthest to fall. We've seen it over and over. The Mississippi bubble, the Nifty 50 in the 1970s, dot-com stocks in 2000, housing in 2007. Different decades, different assets, same structure. A small cluster becomes the future. Capital concentrates. Risk hides inside popularity. Then gravity returns. And what makes this cycle so dangerous isn't that it happens, it's that every time people believe it's different. So let's bring this to 2026. Right now, if you own a standard S&P 500 index fund, the thing most advisors tell you to buy and hold forever, more than 30% of your money is sitting in just 7 companies. 7 out of 500. Think about that for a second. That's not broad diversification. That's concentration wearing a diversification costume. It's like building a house and being told it's structurally sound because it has 500 support beams, but 150 of them are decorative and 7 are holding up almost the entire roof. Those 7 beams are incredibly strong right now. They've been getting stronger for years. Record profits, dominant market share, revolutionary technology. But strength isn't the same as invincibility. The higher the valuation, the less room there is for disappointment. And when that much weight sits in that few names, the index stops being a reflection of the economy. It becomes a leveraged bet on continued perfection. And most people don't even realize they're making that bet. Now let's make this simple. This isn't about predicting a crash. It's about understanding structure. The S&P 500 is market cap weighted. That sounds technical, but all it really means is this. The bigger a company gets, the more of your money automatically goes into it. The more its price rises, the more new money flows into it. So success feeds allocation, allocation feeds more buying feeds higher prices. It's a momentum loop built into the system. Now imagine one of those top companies drops 40 or 50%, not because it's going bankrupt, just because expectations cool off. That has happened to nearly every major tech stock at some point. If a company that makes up 7% of the index drops 50%, that alone shaves 3 to 4% off the entire S&P 500. Now multiply that across several of the top holdings. You could see a 20 to 30% decline in the index even if the other 493 companies are relatively fine. That's the part people miss. When concentration rises, the index becomes more fragile. It takes fewer things going wrong to cause significant damage. Again, this is not fear, it's math. And math doesn't care about narratives. Here's where this gets uncomfortable. Most people hear index fund and their brain translates it to safe, diversified, conservative, responsible. But diversification isn't about how many names you own. It's about how your risk is distributed. If 30% of your future depends on 7 stocks staying expensive, that's not neutral. That's a bet, a big one. And most investors never consciously chose it. They just defaulted into it. And that's the illusion. The industry frames buy and hold indexing as passive and prudent, but in 2026, with concentration at historic highs, doing nothing is not neutral. It's an active decision to accept concentrated exposure. I'm not anti-index, I'm anti-blind indexing, because the risk isn't that those companies are bad. The risk is that they're priced for perfection, and perfection has a short shelf life. When you understand that, the goal shifts. It's no longer how do I maximize upside, it becomes how do I survive different outcomes. And that shift changes everything. So if that's the reality, what do you actually do? Not theory, not panic, just practical steps. Step 1. Check your exposure. Don't assume, look. Open your brokerage account. Pull up your index fund, check the top 10 holdings, and add up the percentages. If a quarter to a third of your money is in a handful of stocks, you're concentrated. Most people have never done this. 5 minutes of clarity changes how you see your portfolio. Step 2. Reduce concentration intentionally. That doesn't mean selling everything and hiding in cash. It means balancing the imbalance. You can use equal weight funds where every company gets the same allocation. You can add international exposure where valuations are lower. You can tilt towards small and mid-cap stocks that haven't run as far. You can add real assets or bonds that don't move in lockstep with mega-cap tech. The goal isn't to abandon growth. It's to stop letting one theme dominate your entire future. Step 3. Build a cash buffer. This is the most underrated move in investing. If you have 6 to 12 months of expenses in cash or short-term equivalents, you remove desperation from the equation. When markets fall, you're not forced to sell. You can wait. You can even buy. Liquidity gives you emotional control, and emotional control is what separates long-term builders from panic sellers. None of this is flashy, but flashy is usually what blows up. Let's fast forward. It's late 2027. Something breaks. Maybe it's a recession. Maybe regulation hits big tech. Maybe growth just slows. Doesn't matter what the trigger is. The mega-cap leaders drop 40%. The S&P 500 falls close to 30%. If you were fully concentrated through a standard cap-weighted index and planning to retire soon, your portfolio just took a hit that changes your timeline. You feel blindsided. You feel betrayed. You thought you were diversified. So you sell some, maybe half. You tell yourself you'll get back in when things feel stable. But stability only comes after prices recover. Now picture the alternative. You checked your exposure in 2026. You trimmed concentration. You added international, some value tilt, some bonds, a cash buffer. Your portfolio still drops, but maybe 18–20% instead of 30%. It's uncomfortable, but not catastrophic. And because you have liquidity, you don't need to sell. In fact, you rebalance. 3 years later, when the cycle turns, and it always does, you're not digging out of a hole, you're compounding from a position of strength. Same market, different preparation, different outcome. Here's the mindset change most investors never make. Wealth isn't built by hitting home runs, it's built by not striking out. Chasing maximum upside feels exciting, it feels smart, it feels ambitious. But the investors who quietly end up wealthy over decades are usually the ones who avoided catastrophic losses. They didn't need to double their money in a year, they needed steady compounding and survivability. If you can earn 7 to 9% annually and avoid the 50% drawdowns that take a decade to recover from, you win. Not because you were aggressive, but because you were disciplined. The game isn't about predicting crashes, it's about designing a portfolio that doesn't collapse when you're wrong. Because you will be wrong sometimes. We all are. Markets change, leaders rotate, valuations compress, narratives fade. The only durable edge regular investors have is structure and behavior. Structure limits risk, behavior protects discipline, and discipline compounds. So if I wanted to invest in 2026, I wouldn't start by asking, what's the hottest stock? I'd start by asking, where am I unintentionally concentrated? I'd check my exposure. I'd reduce single-theme dominance. I'd build liquidity. I'd set simple rebalancing rules. Not because I'm predicting a crash tomorrow, but because I respect the fact that cycles always turn. The biggest investing mistakes in history didn't come from bad companies. They came from overconfidence in good ones. And right now, the market is heavily tilted toward a small group of exceptional companies priced for exceptional outcomes. That might continue, it might not. Your job isn't to guess. Your job is to survive both scenarios, because surviving is what lets you compound. So tonight, open your portfolio, look at the top holdings, do the math, decide if you're truly diversified or just comfortable. And if you want more breakdowns like this, rational, structural, no hype, subscribe, because investing isn't about following the crowd, it's about understanding the game you're actually playing.